Good afternoon. This is Sean Golding with Golding and Golding, here to discuss strategies and tips for taxpayers who may have underreported income with the IRS. Now, it's not uncommon for taxpayers to accidentally have underreported their income. Oftentimes, this is not a huge concern. If the taxpayer did intentionally underreport income, then it can become a bigger issue because there are issues such as fraud and evasion they have to be aware of. Let's jump in and talk about it for a little bit. So, when you're evaluating underreported income, it's important to look at a few different factors first. First, was it willful or non-willful, right? Did you get $3 from a bank and they didn't send you a 1099 and you totally forgot about it and it wasn't included in your tax return, right? Or did you win $200,000 and you thought, you know what, I don't want to pay tax on this. It was paid to me in cash. It was transferred to me in crypto. No one's ever going to find it. And so you kind of knowingly or willfully went ahead and didn't report it. It's different, right? One is accidental mistake, not a big deal. The other one is a bigger concern, and there might be a going concern for getting into compliance. Another thing to consider is, was it U.S. or foreign, right? If it's foreign, then the issue becomes, is it just the unreported income? Did you also miss foreign tax credits that could offset the income? Do you also have unreported assets that you didn't report? So there's forms such as the FBAR and the Form 8938 that should have been filed. Those are other factors to consider as well. And then when looking at the non-compliance for the underreporting, a few things to look at is, for example, does it qualify for reasonable cause? For example, was there a legitimate reason? And then when you're determining reasonable cause, trying to seek a penalty waiver, there's various factors that you would use. The Internal Revenue Manual is a great place for that. Another concern is whether it's non-willful. Some people say the term negligence, but typically it's referred to as non-willful. If someone is non-willful, then the IRS does still have the opportunity to issue penalties, but typically the penalties are going to be less. It's nothing criminal. It can't be. If a person is willful, then it becomes a much bigger concern, because if the person is willful, then it could lead to other crimes such as tax evasion or tax fraud, which can be either a crime or civil. With tax fraud that's civil, there's no statute of limitations. So essentially the IRS can go back as far as they want. So all these issues are something that you should consider before, reaching out to law firms or tax professionals who are going to scare you that you're going to be doing 25 years in prison just because you missed some income. Not all types of underreporting is the same. So kind of expanding upon the example before, let's say that you have interest, right? And one bank doesn't send you your 1099, right? And then it turns out that you missed $5 worth of income. Is that going to be a big deal? No, right? You can go back and amend it. It depends how much time has passed, whether the statute of limitations has already expired. But generally, that's not going to be a huge problem, right? Most statutes stay open for about 3 to 6 years, depending on the facts and circumstances. How much income was underreported? Does it refer to foreign FATCA assets, Foreign Account Tax Compliance Act? But not a huge problem. Whereas if you have significant amounts of unreported income within recent years, that's a much bigger issue, because first of all, you're in the statutory period. Second of all, if it was intentional, it could lead to bigger problems. And just because there's a large amount of unreported income doesn't mean it's intentional, but you got to look at the facts and circumstances. For example, if someone earns $80,000 in a year and it turns out they have unreported income of $200,000, that's going to be different than someone who earns $90 million a year and has $10,000 of unreported income, right? It's relative to the facts and circumstances. You have to look at the totality of the circumstance. When it comes to foreign income, there's a lot more issues on the table to consider. At our firm here, we specialize exclusively in offshore and international tax. That's all we do. And so when you have unreported foreign assets along with unreported foreign income, it could lead to fines and penalties. And so it's important to note that if you're a U.S. person for tax purposes, so typically means you're a U.S. citizen, a lawful permanent resident, a foreign national who meets the substantial presence test, you're taxed on your worldwide income. Now, most other countries don't operate that way. Many people who reside in the United States or outside of the United States are considered U.S. persons for tax purposes aren't aware that they have to report this foreign income. So even if it is a large amount of income, if it's foreign, it could simply be the person didn't know. Maybe they live or the income is sourced from a country that doesn't tax personal income, or it might be a category of income that's not taxable, or the person already paid foreign taxes on that income, didn't know they had to do anything about it here. So when foreign income is involved, oftentimes it expands the concept of non-willfulness. If you underreported income and you live overseas, you may also qualify for something called the foreign earned income exclusion. And what that does is it allows certain wages and related types of income earned overseas, upwards of $120,000 a year, to be excluded from the tax return, along with some housing deductions. So some people may not file the return because they didn't know they had to include the foreign income, and that's all the income they have. Or they filed the return, they didn't include a significant amount of foreign income. Then it turns out that it's wages, and let's say it's $100,000 of wages. Well, once they go back and amend the return, they may not have any tax liability anyway. And this is super common in a lot of foreign countries, especially large expat communities. There is a misunderstanding that taxpayers who earn less than the foreign earned income exclusion amount don't have to pay taxes or don't have to report that. While they may not end up having an overall tax liability, it doesn't mean that they don't actually have to report the income. So for taxpayers who are out of compliance for foreign income and domestic. So if you have foreign income, you can also have domestic, but if all you have is domestic, then the programs are a little different. If you're willful, then the only program available is the Voluntary Disclosure Program, VDP. If you're non-willful, there's various other programs available to you. There's the streamlined procedures, there are the delinquency procedures, and there's reasonable cause. We got a ton of free information available on our main website and our sub-website. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.